Hi, and welcome to your Saturday Q&A marathon, where we talk macro, try to make sense of markets that, they don't make any sense. But more importantly, today, we answer your questions so we can become better investors. I'm your host, Steven Van Metre, and thanks for joining me today. Just some rules for those of you who don't know that you can submit questions to the show. You can submit them by emailing me. You can find my email address on my website. It is linked in the description below. You can message me on Facebook or LinkedIn. And there are some rules regarding questions. Due to my licenses, I cannot give trade advice. So if you send me a question regarding trade advice, I will not be able to answer it. I have to be able to at least have an opinion or the ability to answer your question. And if I can't, I'll let you know. And I do not take questions based on, hey, will you watch this video and comment or read this report, or hey, so-and-so said this. If you have questions about other people's research, I would appreciate if you would direct your questions to them. If you do have a question about someone else's research, please frame it in a question, but do not reference them or where you found it from, but reference it in your own words. And last rule. If you're gonna send me an email, you gotta put your first name in there so I can at least write back to you instead of saying, hey, big dog 44 or whatever I usually get. So on we go. Question number 1. Really appreciate your response to my question on Sunday. You're very welcome. I would like to follow it up with a couple more questions regarding the reasons why we have not seen the S&P 500 index crash as anticipated. I have heard some of those who postulate the reflation-stagflation hypothesis claim that the markets are a forward-looking mechanism and that a lot of the macro data being analyzed describes the past. I would like to hear a response to that. All right, so here's the deal. Let's start with the first one. Is the market a forward-looking indicator? At market bottoms, it is. At market peaks, it isn't. And if it was at the peaks, it would lead interest rates lower. But in this case, we always see that interest rates lead stock prices lower. So it's not until market bottoms do we get forward-looking indicators, because right now people are buying stocks. They think there's a massive recovery going on in the economy. They're ignoring the data. They don't care. They believe that this is the opportunity. And so far, the data says they're wrong. Now, in answer to your question about a lot of the macro data describes the past, I'll go one step further. 100% of the macro data describes the past. Because if you had macro data that described the future, you wouldn't be sending me a question, because you'd be the richest person in the world by far of anyone's imagination. So all the macro data does is tell us the past. And what does the market telling us? Well, the market's saying we're going to have a big bullish V-shaped recovery in the economic data. And what has the economic data said? Nope. It's saying just the opposite. We saw a fishhook recovery at best so far, and we're starting to see that the fishhook is not going to last probably a whole lot longer. So all the macro data does is tell us who's right and who's wrong. And in this case, are interest rates, treasury yields going to be right, or is the equity market going to be right? And so far, the bond market is telling us where the economy is headed, lower. So and the other reason the S&P may not have dropped is, and I've struggled with this, that people would think that using their stimulus checks to speculate in stocks was a great idea for them. But you have to understand, back in April and May, what did people think? Oh, this was going to be over. Everything was going back to normal. Well, I think it's becoming obvious things aren't going back to normal. And as my dad says, maybe not even in his lifetime. And that's realistic. Will things be back to normal, say, in the next 10 years? Probably not. So people gambled on it, and now the harsh truth is a lot of those people that gambled on their stimulus checks may not even have a job. I mean, remember, there's 30 million Americans that are on some form of unemployment benefit, and that's a lot. So we'll see if everyone's appetite for speculation is there as the end of July is coming. The last stimulus check is in the third week. And then after that, everyone's unemployment benefits drop below what they were used to making. So be interesting to see how that plays out. Also, is it possible for the Fed to successfully jawbone the markets higher for a really long time? No, it isn't. The reason the Fed's gotten away with jawboning the markets higher over this last, say, 10-year period is mainly they had corporations buying massive amounts of shares back, and they were priced insensitive. They just say, hey, we're buying, oh, we'll buy some more, and then some more. They never asked how much. They said, buy 1,000 shares, buy 1,000 shares, buy 1,000 shares. The price was what the price was. So no, I do not believe the Fed can be successful long-term job boning the market higher. Eventually, the weight of the economy will prove that people overpaid for stocks. I mean, and the only question is, are they happy with that? You know, when I buy a car, if I go down to a dealership and I see that there's what's called a dealer markup, where there's MSRP and then because we're the only dealership nearby and we think you're too lazy to drive down to Los Angeles, markup price, I don't buy from them. Even if they say, oh, don't worry, we'll come off that price real quick. I'm sure you will, because real quickly I'm going to be in my car driving 90 minutes south. And along the way, I'll find someone who will give me the car at a fair price. So the real question is why are people overpaying for something? And are they going to be happy with it? Hey, as long as if everyone's happy overpaying for stocks, that's not my problem. I don't think it works out for them. Not my problem. I've heard in your videos that you anticipate markets will crash in the coming few months. Yes. What do you think will trigger the collapse? As always, thanks for your show and taking time to share your insights and answer our questions. Hey, you're very welcome. What do I think is going to lead the markets lower? The Treasury bond market. Interest rates are going to fall, drive stock prices lower, which will be very bullish for the dollar, and then that will in turn unwind the equity market. As if we don't have second quarter earnings coming that are saying things are bad. I mean, really bad relative to where stock prices are. So you have this massive discount. You have stock prices up here and going to have profits way down here. And where do you think third quarter is going to be? It's not looking too good now. Probably not going to be. You know, there's that commercial, and I'm not going to use the name, but you'll know when I say the tagline. It says, "A December to remember." It ain't going to be one that people are going to want to remember. I don't think the rest of this year is going to be great. Hi, Steve. Just watching your latest video, I have a couple of questions on the dollar relationship with government debt. So according to your theory, government debt destroys the dollar. All right, let me clarify in case I did say that. Government debt does not destroy dollars. It just doesn't lead to the creation of dollars. It hampers the creation of dollars. So let's go on with your question. I'm assuming this is a particular characteristic to the U.S. as a world reserve currency, as U.S. treasuries are always in demand. Okay, so let me explain then kind of what before we go on with the question is, government debt crowds out the wealth creators in our economy. So if back in the day when J.P. Morgan was the richest man in the country, the federal government went to him when it ran out of money and needed it because he had it. So every time he has to give the government money, that even though he had all of the money, it was less money he could have used to create wealth in the economy. So if I, as a business owner and taxpayer, am paying taxes and I have to pay more of my income in taxes, that's less money that I could go out and do things with. So the government crowds out the wealth creators in our economy. So let's say I wanted to hire someone, but my taxes are going up, I might think twice about that and say, well, I can't afford it because I have to support the government who's running these ridiculous deficits. And I'm not referring to the short term, I'm referring to the long term. So what government debt does is it crowds out the wealth creators because they have to financially support the government rather than going out and creating jobs and businesses and new things that create dollars. And how are dollars created? Well, when I go out and borrow money. So if I'm too busy paying taxes, then maybe I'm not interested in taking a risk of borrowing money to expand my business because I'm not confident my business expands. So that's the problem, is government debt crowds out the private economy. The same wouldn't apply to other countries. I think it does. I think it's very, very clear that anybody on a debt-based economy runs into the same problem. I mean, look around the world. Are you seeing where massive debt in Japan or the Eurozone has led to an economic boom? No, because they're all in debt-based economies. So it's the same thing. It just, when it comes to the reserve currency, it's a bigger problem because as a reserve currency, we need to create dollars for everybody. Japan doesn't really need to create yen for the U.S. So, I mean, I don't. As an American, I don't have yen. I don't have an account with yen. I don't transact in yen. But in Japan, there are people that do transact in dollars. They need dollars, and well, they need them. Somebody has to create them. They're created by borrowing. Borrowing creates dollars in a debt-based economy, and the government snuffs out the private sector. So that's what they do. Further, is it safe to assume that the large amounts of debt issued by the government to pay the stimulus bill won't create inflation? Well, yeah, the evidence is pretty strong about that. I mean, we've seen the stimulus in the short term can be inflationary, but in the long term it can't. I mean, we can go back and look at when Obama was president and he had his shovel-ready stimulus package. It was just, I was going to say trumped up to be inflationary, but that's a poor choice of words. But it was really, at the time, it was like, this is going to be massively inflationary, and it wasn't. And again, in the short term, stimulus is when it hits the M2, the money supply. But after that, I mean, roll the dice. Depends on where the money goes. So no, there's no evidence that over the long term that government stimulus is inflationary, because it comes with a lot more government debt. At what point issuing more debt becomes inflationary? It doesn't. Debt in a debt-based economy is deflationary. What is inflationary in a debt-based economy? Saving. See, if I save money to buy a car, that's future spending. So if a lot of people save up money and go spend it, that creates inflation. If I go borrow money right now, I have more debt. In short term, that loan creates inflation. In the long term, as my debt load increases, well, I have to pay on that debt. And how do I pay on it? Well, it comes out of my discretionary spending. So the more debt I have, the less money I have to go spend in the economy tomorrow. So debt in the long term is deflationary. Also, I hope my VIX prediction in the YouTube comments was kind of close. Actually, if you are who I think you are, your comments were probably the closest. Looking forward to that story, and I am looking forward to sharing it with you at some point. I've been watching your videos, and a recurring point that comes up is the Fed does not have the mechanism to print or create dollars. I was wondering how dollars are created if there is a lack of supply, or how they are created in the economy under normal circumstances. There's only one way dollars are created, and that is through borrowing. And that is the reason why the Fed persistently tries to drive interest rates down, because if they get interest rates low enough, then people start borrowing, and that creates dollars. And until interest rates are low enough where people are borrowing to create dollars, interest rates aren't low enough. And in the meantime, interest rates low interest rates are a symptom of tight monetary policy and tight financial conditions until they are low enough to spur borrowing demand. And that's why every Friday we take a look at the credit data, because it tells us, are interest rates actually low enough? So money's created by borrowing. I've been following your work on YouTube for some time now. Great stuff you publish on macro, very digestible form. Keep it up. Hey, you're very welcome, and I plan to. I've got a question regarding the gold with a view on upcoming, maybe already secretly applied yield control curve by the Fed. Okay, so let's just be very clear. There is zero evidence, that there is any yield control curve being done, because they don't need to. Quantitative easing does that. So there's no official path on that, on yield control curve. You mentioned in one of your videos that your sentiment for gold turns bullish when real interest rates go negative, or fall. So as long as real interest rates are falling, bearish, then I am bullish on gold. But right now, I believe that real interest rates are going to be rising. I don't want to use, real interest. So put a real in front of this. Real rates are going to rise, and that will be bearish for gold. I'm going to stick to that. Like I said, I could be wrong, but I'm going to stick to that's how it should be. Again, we can see that dislocation. Luckily, I have a backup plan in case that fails, but that's okay. In the view of yield control curve being implemented officially in the Fed's policy, would you consider it a major bullish signal for gold? Normally, yield control curve keeps real rates persistently negative. Well, I don't think it's going to be implemented anytime soon. There were 2 times in the United States we had yield control curve. One was during World War II, so obviously we're not in a world war, so we can... Oh, wait, or is that the only time we've ever had? That is the only time. So if we look... one time that I know of. So what is yield control curve used for, say, in Japan? To make interest rates go up. That's why the Fed's not worried about implementing them. See, if yields go negative, that's deflationary. So why would the Fed then do yield control curve? To bring rates up. That's why we're not seeing. See, everybody thinks, oh, the Fed needs to do yield control curve because rates are too high. That's what QE does. They don't need to do it. That's why Powell's like, yeah, well, we're still looking into it. Look, if the 10-year Treasury goes negative, then we'll probably see yield control curve, because then they got to bring yield up out of negative territory. That's what they did in Japan. Would that be bullish for gold? Probably, yes. But in the short term, you got to think of this. Real yields, because it's part of the real component is inflation or the consumer price index, it lags. So it runs behind yield. So in the short term, I still think it plays out right, like it did in the great financial crisis for me, but it could be wrong. But like I said, I got a backup plan. Thanks in advance for your reply. You're very welcome. May the macro gods always be with you. Whoa. Hey, I will take that to the bank. Hi, Steven. I'm watching you since the lockdown in Serbia, and I didn't miss a single video. Cool. Hey, a viewer from Serbia. I think you're the first that I know of. My girlfriend doesn't understand a single word. That's great. But she is laughing and starts to imitate you whenever she hears, hi, I'm Steven Van Metre. Awesome. Well, there you go. Hopefully she thinks that's funny too. We both like you very much. Hope your channel will grow. That'd be very cool. Really, I have zero expectations for where this channel goes right now. If Steve from the future showed up and said, hey, in a year from now, you'll be turning off your channel, I'll be like, oh, okay, well, maybe I will. I don't know. Maybe no one will listen then. Maybe there'll be a million followers. I have no clue. No expectation of where this goes. Have a few thoughts or questions, please comment if you can. Would you agree that there's some form of socialism and no free market in the USA now? I would agree that there has not been a free market in the USA for a long time. Crony socialism, privatization of profits, socializing debt for some. I mean, is it even legal the Fed can buy individual corporate bonds and pick winners and losers? No, but they're doing it anyways. I mean, it's a gray area. The Federal Reserve Act, if you really want to go draw a line, says no, but right now no one's going to stop the Fed from doing that. What is the message for managers of big companies to be more reckless and take more risk, knowing they will get bailed out? Yeah, it's all about fiscal irresponsibility. Hey, rack up all the debt you need, buying your shares back and paying yourself giving yourself stock options so you can get rich. And if things go bad, we'll just bail you out. Yeah, I totally do not think that is a good thing. I think that's bad, and I think it sets a bad precedent. Who can forbid them to buy their own shares and yeah, see, there we go. Of course, money will evaporate eventually, and they will need more and more money, and they will get it, as we can see that. They created more debt in the last 3 months and 12 years. And moral hazard, yes, totally agree with you. Regarding inflation, deflation, yes, we can see deflation pressure mostly in energy, but that is recovering in the short term and compensated in food. And you said Medicare, I'm assuming you meant medical. But general effect for prices now is only disinflation, not deflation yet. That is correct. While the CPI graph is flattening. So year after year, we're experiencing low inflation. Your US dollar is losing purchasing power month after month for years. And yet we have deflationary pressure, but what we are experiencing right now is still inflation. Well, and then you put it, or disinflation, since it's lower and lower. That is correct. It is disinflation. And it's a little less than 20% for the last decade. It would be higher if they applied measuring standards like 30 years before. Totally agree with you. We will have to see if it will go to the short-term deflation, but I doubt it. I would rather go with negative interest rates than to allow deflation. Perfect tool for inflation, although you say they don't have tools. Yeah, it's a big question mark if the Fed actually even has the power to implement negative interest rates. Some people say they don't have the legal authority to do that. So, I mean, actually, of the parts of the Federal Reserve Act that I've seen, they don't, because they actually do have to pay interest on the excess reserves to the bank. So how do you do that in a negative rate environment? But I'm going to go and stand by my view that we are going to see outright deflation like we saw during the great financial crisis. Comments in section 2 regarding CPI goods. What about asset prices? Real estate, shares, gold, crypto. Real estate is up. Stocks are up. How do you explain that? Well, you already know the answer, my friend. It's not in the CPI. Look, if the Fed actually put all these things into the CPI, we would see inflation. Do you expect that prices of assets will go up in the same way after a few years after initially relative stagnant period like we see now? What I see is asset prices crashing like they do during deflation, and then slowly growing from there like they have after past deflationary busts. I read somewhere in April people had 10% more income than in April last year because of unemployment stimulus. That is true, more money than while working. How is that deflationary? In the short term, it's not. In the long term, it depends on where the money goes. So if they have extra money and they turns out they get their jobs back and their pay back and they can go spend it on trips and toys and whatever, it's inflationary. But if it needs to go to debt service and to living expenses, it's not. So short term is inflationary. Long term, you can draw a big question mark. I think it's reversed for you. But given the fact that there's 30 million people unemployed and it doesn't appear that people are going to be getting a lot of their jobs back as more and more companies lay off, it's going to go to debt service and living expenses, not into discretionary spending. So I'm going to say my forward-looking view is going to be deflationary. But in the short term, when stimulus hits the bank accounts, which factor into the M2, it is inflationary. They can always print more, and what prevents them to give people 50% more income through stimulus or universal basic income? It's simple. That we have to borrow the money, and the more money the government borrows, the more they crowd out the private sector, the weaker the economy gets. So there is a limit. Congress knows it. Trust me, they know. I mean, look at other countries. This would have a huge impact on CPI, not only asset prices, and it can maintain the difference. But here's the other side. Look. If somebody paid me 50% more to work, and I was assembled cars, I wouldn't need to assemble cars. And well, in fact, if we paid everybody 50% more to sit at home, then nothing would get built. It can't be inflationary at some point because you'd have money and nothing to buy. That's interesting. Inflation is desirable now, or better stay stagflation rather than deflationary depression. That is the only way to fix. Look, in a debt-based economy, inflation is always desirable, especially the more debt you have. Stay well and wish you all the best in regards from Serbia. Hey, thanks. I appreciate your questions and hope you and your girlfriend keep watching. Thank you for all the information you provide. It seems like the goal was really to devalue the dollar. That's why the Fed went so big, and it seems to be working. Do you think this is the case? With the devalued dollar, will this explain high stock prices? Yeah, I think that was the goal, was to take some pressure off the dollar. They did it in the short term. They got hedge funds to sell out of their dollar, speculative dollar longs. It did bring some downward pressure on the dollar. It did help boost stock prices. But in the end of the day, the Fed's got to do way more than that. The Fed's got a problem. I mean, they can't devalue the dollar because the only way to devalue the dollar is to create more dollars. Well, how do you create more dollars? You need people to go out and borrow. Well, how do 30 million people on unemployment borrow? They don't. In the meantime, you're going to need lower and lower and very low interest rates at some point. Hi, Steve. Your videos are very informative. Thanks for publishing your thoughts on YouTube. Hey, you're welcome. I have a few. Okay, more than a few questions I'd love to get your thoughts on. You say the QE is not money printing, as the dollars do not go out into the company, or we'll say country, but is rather collateral, which is key for the deflation thesis. However, if that is the case, when the U.S. Treasury is depositing stimulus checks to Americans' accounts, are they not issuing U.S. Treasuries for the stimulus, which is directly increases the M2? So yeah, they are issuing Treasuries. There's no doubt about it. And you're right. In the short term, stimulus is inflationary when it hits the M2. No argument with there. It's always a question, as I mentioned on a previous question, is where does it go next? If the government decides to send everyone $5,000 in the next round of stimulus checks and issuing U.S. Treasuries to pay for it, isn't this QE money printing getting out of the money supply and into the economy? Well, the QE part isn't, because it's still debt. You got to remember, QE just swaps a Treasury security with an average maturity of 7 years at a bank for cash. It has nothing to do with stimulus checks. The Fed's QE has zero to do with the stimulus. And it might act like it is, but it isn't. They're just literally pulling those Treasury securities out and giving the banks cash, which pay less interest, and the banks can't use that cash. So yes, in the short term, any more stimulus is inflationary. In the long term, question mark. If I understand world dollar liquidity correctly, the U.S. will live in a debt-based. We live in the U.S. We live in a debt-based economy, and that has to continue for continued economic expansion basically forever. Correct. 30,000-foot question. Isn't this economically unstable in the long term? Why can't we run an economy that's fiscally conservative at the expense of short-term growth and ensure long-term sustainability? All right, so if you're having a late nighter and you're really bored, like some people get, and you think about monetary policy, you come to the quick conclusion that For debt-based economy to work long term, the amount of debt has to go to infinity, to the extent where you're borrowing money to pay on existing loans, to where we write computer programs to borrow money literally every fractional second of the day and night to continue to pay on all the loans, because the amount of debt has to go exponential and the system breaks. So yes, it's not just unsustainable. The system was never designed to be sustainable. Debt-based economies are unstable because you have to have hyperinflation at some point. You have to have debt go to infinity. They are not sustainable, period. And that's why we get these boom and bust cycles, because we try to constrict credit growth and we create a bust. But if we let credit continue to grow, you get hyperinflation and the system fails anyways. So why don't we have a fiscally conservative economy? Well, because we have a debt-based economy, and debt-based economies were designed specifically to support large governments. If we had a savings-based economy, we would have a very tiny government. People like big government. Some people like big governments. A lot of power comes with big governments. But if we had a savings-based economy, we'd have a very small government, and we probably wouldn't have things, like wars and whatnot, because big governments like wars. They like power. They like influencing people. They like telling people what to do. So debt-based economies support big governments, and they are inherently unstable. At what point does debt become too much to bear for the nation? I assume it already has. And what are the consequences? A currency reset, credit downgrade? No, the consequences, you just get slow growth. You get very, very low growth until the debt is paid down. And that's exactly what happened following the Great Depression. Former Fed Chair Bernanke criticized the Great Depression Fed as not doing enough. The reality is people lost faith in the Fed because they learned, as we will eventually learn, that the Fed doesn't have the power to inflate asset prices or create economic growth. And so what happens is you get too much government debt, it crowds out the private economy. The only solution becomes, as we saw after the Great Depression, a 10-year period of austerity, where you have below trend economic growth. It's the answer. It's either that or you eventually have a war, World War II. How do we devalue the dollar? Don't know. How do you devalue it? Don't know. Currency reset? Maybe. Credit downgrade? Fed could. No, that's not likely. Let's see where we are in the schedule here. All right. In your Macro Monday 623 video, you mentioned that if we want to see a weaker dollar, the U.S. to lower cost of debt and compete in trade, governments need to spend less, run a surplus, and pay back the debt. Why does this weaken the dollar? It's simple, because it puts more money back in the hands of the private sector, who can actually borrow and create dollars. See, that when the government borrows, they don't create dollars. But when you and I borrow, we create dollars. So if there's more money in our hands, we're more likely to go out and borrow. Makes sense. I mean, imagine if our government could run a balanced budget with our tax rate being half of what it is now. Could you go buy that home you really wanted, or take that vacation, or the car, or whatever it is you want to do? Yeah. And how would you do it? You'd borrow money, create dollars. I know you mentioned that you think gold is going down in the near term. I do, although this week it seems to have somewhat of a breakout. Yes, it has. Why do you think people who will sell equities will jump into gold as a safe haven versus U.S. Treasuries? All right, well, simple. In deflation, I have less money. In deflation, I have less money, but my debts don't go down. So that means I have to put what money I do have to pay my debts. That means I have less money to go buy things like gold, and hence brings gold down. And then the question is, why does gold get to be a safe haven? If I have less money, then why does gold become worth more? If gold is an inflation hedge, how is it an inflation and a deflation hedge? How is it worth more when I have less money to buy it? Doesn't make any sense, right? Less money means asset prices come down. So apply the same logic to a house. If you're gonna sell your house and my income and everyone else's income were going down, how would it just support your housing price? It doesn't. It means that people that come and buy it say, well, I can't pay what you want. I don't have the resource, the ability to pay. So housing prices come down, stock prices come down. I think gold comes down. Could be wrong. I think gold comes down. In one of your videos, you mentioned war does a good job of bringing nations out of recession, which is historically supported. Yeah. How do you think your thesis changes if the U.S. gets into a war or strong military conflict for China this year? Simple. I don't think we do. Look, President Trump is facing re-election. Now, granted, right now the polls are not in his favor. Now, they weren't in his favor this time when he got elected 4 years ago either. And certainly, if there's one person you don't want to bet against, is him. So you have to ask yourself, would it be to his reelection benefit to go start an armed conflict with China? No, I don't think so. So I don't think that's going to happen. Would it change my thesis? In the long term, it would. In the short term, it would not. How do you think an immediate medical breakthrough or near-term material therapeutic development impacts your thesis? Wouldn't equities react positive to this? Yes. So, but the other side is, how long is it going to take to go give everyone a shot? Well, first of all, we don't have the capacity to make enough vaccinations now for everyone in a year. So we'd have to get that kicked up. We don't have enough needles to give everyone a vaccination if we had the vaccination. We don't have enough people to give everyone a vaccination if we had a vaccination. And if people needed 2 or more vaccinations, well, then we'd have to create more vaccinations and more needles and get more people to go do it. The reality is it could take years if we could get everyone inoculated. So yeah, in the very short term, but the reality is, in my opinion, if we did proper social distancing, wear masks, and then contact tracing, we'd have a better chance of killing this thing in the 2 or 3 years it would take to get everyone a shot if we had a shot today. And that's assuming it worked. What are the thoughts on crude shipping tanker industry and their terrible equity performance for the past few months? I have no opinion on that. I don't follow the crude shipping tanker industry, so I have no idea. You briefly mentioned floating storage during a brief discussion of crude inventories, and though these companies will generate a lot of cash this year, for some, their best in history, their equity performance does not follow the underlying performance, and it is a low. Is there a way to make sense of this? Do you have any thoughts? I have none. If anyone does, we can talk about that, but I don't. I just know there's a lot of floating storage out there, and that adds to my bearish view on crude oil. It's interesting to see non-performing companies like Hertz get bid up by, we should add, inexperienced investors and performing companies with a healthier balance sheet not getting much interest. Yeah, because people don't realize that bankrupt companies are not something you should generally pay with. There is a reasonably high probability that the stock price of a bankrupt company goes to zero. But people don't know that. Thanks for the continuous videos. You're welcome. My question about the Fed's yield control curve. Look, I'm having trouble with that. So maybe we should dial the yield control curve questions down. So I'm just kidding. Can the Fed potentially keep the stock market going up by manipulating the Treasury yield curve? They're going to try to, but no. See, here's the problem the Fed doesn't know. Lower yields lead to what? Lower stock prices. Blows your mind when you figure that out. I hear how confident you are about stocks going down, but I don't see it. Maybe it's because of my limited knowledge. Maybe the Fed tools are not so limited. Look forward to your answer. Yeah, so here's where there's some gray hairs, as my wife occasionally points out that I am in blatant denial of. I've lived through 2 recessions, invested through 2 recessions, and been in this industry in 1 recession. I know how this plays out. I know the Fed does not have the tools and abilities we assign it. Could this be the first in history? It's possible. Look, I've read books on the history of monetary policy. Never, ever once in history has any central bank in a debt-based economy managed to prop up asset prices through a recession. I'm just going to go with the 100% probability that this isn't the one that works because we're not doing anything different. And if they did, why haven't we figured it out? I mean, central banking's been around well over 100 years. Why haven't we figured it out? Is it because we're doing the same thing we did during the great financial crisis? We're just doing more. And that's always the reason. Well, we just didn't do enough. Yeah, well, okay. You didn't put enough lighter fluid on the fire. That's why it went out. Well, good. Put some more on because all they're going to do is drive interest rates down and stock prices down and make me look right. Thanks for addressing my earlier question. Very helpful. Hey, you're welcome. I really appreciate that you are informative while at the same time upfront about the unknowns. Look, I have a crystal ball. I really actually do. It is crystal and it is in a form of a sphere. And it is on a little stand and it does look like a crystal ball. It does not work. If it can work and you can see the future, I own it. You look in the future. We'll be super rich together. Totally cool. And look, we don't even have to hang out if you don't like me that much. You can come by, we'll look at the crystal ball. We'll get the answers. I'll keep the crystal ball. You keep your visionary ability, and we could meet occasionally if you prefer. But no, I'm right about many things, and I will be wrong about many things, and I get criticism for that. I've gotten plenty of emails about how I'm wrong about the short-term cycles of the market. I've gotten plenty of negative comments about it in the comment section, which is why I block them. And people don't realize I used to work in the IT industry. I know how to block things, so don't worry. I'm not interested in listening to negative comments. And look, I know from a macro perspective where things are going. I know where they're going. In the short term, look, best guess. I've never said and look, anyone who thinks they can predict the short term of the markets, let's be realistic about this. Someone says, hey, I can trade the short term of the markets. How much money are you trading with? $500, $5, $5,000? Look, here's the bottom line. Even the biggest professionals and the best and brightest of them can't do it. And if they get one, they can't get them all. They miss more than they hit. Because the bottom line is, can you do it with $10 million? Can you do it with $50 million? Can you make those trades with $50 million of other people's money that you're responsible for? And if you're wrong and lose half their money, they're going to sue you? Can you do it with $100 million? Can you do it with $1 billion? The reality is people can't. You can do a lot of things with small money with cycles because there's no fear of risk. But when you're doing it with other people's money and doing large quantities, it's totally different. So yeah, I am going to be wrong. And that's just the way it will look. If I was right, I'd be super rich. What? And maybe I have a channel about me being super rich. I got one more question on your view on gold. I understand your view on how when real yields rise during deflation, it would place downward pressure on gold. Correct. But in 1930s, it appears that gold miners did very well during the deflationary phase. Why? Perhaps the market was looking past real yields and priced the upcoming dollar devaluation, which happened in 1934. So here's my problem with going back is then we were on the gold standard. And they could devalue gold and make it go up. Today we're on the dollar standard. We don't have the ability to devalue the dollar. The Fed doesn't have that ability. So I think the dollar goes up. I think real yields go up. I think consumer price index goes negative. And that to me is bearish for gold. Now, whether or not gold actually goes down, I mean, I don't know. But like I said, I've got a backup plan. So I'm okay. If I'm wrong on that, I got, again, in the macro world, you have to have more than one, on-ramp. So you come up to the freeway, and it's like, oh, there's only one on-ramp. No, I got to have two, minimum two, maybe three. So, because we were on the gold standard and we're on the dollar standard, I'm not sure I can answer that question. In recent past, I see gold did poorly during liquidation events like last March. Yes, and it did bad in the great financial crisis when real yields rose. And that's where I'm going back to because we're doing the same things we did then, except people are expecting a different outcome. But during that time, even treasuries were selling off. And yeah, the treasuries were selling off because the Fed made a stupid mistake. They actually didn't, okay, let's be realistic. Pretty much everything the Fed does is stupid. But let's get beyond that. Is the Fed should have been doing more quantitative easing. They didn't realize how bad the dollar shortage is. They still don't realize how bad it is. But because they've mopped up so much of the treasury market, it's unlikely, or I'll say improbable, we will see a big treasury sell-off the next time around, the next liquidity event. So what do you think the possibility for a similar outcome in 1930s gold miner is today? I'm going to say low, very low. Could be wrong, but I'm going to say low. That is, and if when real yields rise, gold prices continue to rise because market speculates the Fed will take actions to devalue the dollar. Yeah, I mean, you do get these forward views of, hey, we're going to buy gold now, but it's amazing that the markets can still move even if people aren't selling a lot, Gold can still go down if people aren't buying that much because if people don't go buy, what happens to the price of things? They go down, right? If I had a car dealership and no one came on my lot for weeks to buy, guess what tells me my prices are? Too high. I got to lower them. So yeah, people could be buying gold now hoping something happens, and if it doesn't happen, gold prices can come down. A lot of people, it's like listing your house. I'd like to, I do find it amusing when I get those calls. We'll buy your house for cash today. How much do you want? I'm like, I like $1.5 million. What's your house worth? Nowhere close to that. But you didn't ask what it was worth. You said you wanted to buy it. I'm giving you my selling price. Well, we need an appraisal. I didn't say you were going to get an appraisal. For you, it's $1.5 million. It may only be worth a fraction of that. It is only worth a fraction of that. But that's the bottom line, is what people buy it for and what it becomes worth after the fact is a big question. I still think gold goes down. Could be wrong. Hi, Steve. Been enjoying your show on YouTube. Thanks for sharing all the great macro knowledge. I still have many questions, but one to start with. How does the prospect of deglobalization interact with your thesis? In the short term, not going to happen fast enough. The short term is going to play out. My thesis is going to play out well below that even happens. Long term, it would be bad for world dollar liquidity. Well, actually, then it would be good, because if world dollar liquidity collapses, then my deflation theme stays intact. But I don't think it's going to happen. Unless we change off of the dollar as a global standard, I don't think it happens. But by the time I'm done with my deflation theme, which I believe plays out pretty much this year, it doesn't matter. But long term, it's going off the dollar stand, or going off, or deglobalization is bad, because that's what creates dollars, is that world dollar liquidity cycle. So I'll have to think some more on that one. Also, okay, 2 questions. How would an unprecedented fiscal response such as a $1 trillion infrastructure bill interact with your thesis? I would assign it as in the very, very short term inflationary, but I don't think $1 trillion is enough to do anything. Look at all the stimulus we're having now, and it's not really, look at what the Treasury bond market's doing. Yields are back going down like I said they would, because why? The Fed is still monetizing debt. And that's something we have to understand is, the money multiplier, there is a denominator to it, and it is QE. As long as the money printer is going brrrr, and the Fed's doing QE, look, you can get very brief short-term inflationary blips, but the Fed's going to win that battle. So no, I don't think an infrastructure bill changes my thesis at all. I'm still long-term treasuries at the moment. Appreciate your insights as always. Well, I'm long treasuries at the moment too, and none of these things are changing my opinion at the moment. So we'll go ahead and wrap up here. We've gone a little longer than I thought, but I wanted to get through that last question. And maybe I'll have a video for you on a Q&A video for you on Sunday. Don't know. We'll see what I decide to do this afternoon. The content of this video is provided as educational information only. Is not intended to provide investor or other advice. Shows not to be construed as recommendation or solicitation by signing security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Please express the video that I do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.